A geopolitical conflict between the United States and Iran isn't just another news headline. It's a direct threat to the world's energy lifeline. Because in today's interconnected global market, oil isn't just a commodity. It's power, it's stability, it's inflation, it's war. And when massive producers and strategic choke points are drawn into conflict, prices ripple across markets. Inflation rises. Consumers feel it at the gas pump. But why? And how deep can the impact go? Let's break it down. Oil markets are not rational. They are psychological. When tension rises between the United States and Iran, traders don't wait for real supply disruption. They price in fear first. That's because Iran sits at the heart of the global oil network. Tehran produces millions of barrels of crude each day, a significant share of global supply, and plays a central role in the Middle East's energy dynamics. But that's only part of the story. The bigger factor is geography, especially the Strait of Hormuz. This narrow waterway links Persian Gulf producers with the rest of the world. Nearly 20% of the world's liquid oil consumption flows through it every day. That means far more than Iranian crude is at risk. Crude from Saudi Arabia, Iraq, Kuwait, and the United Arab Emirates also travels the same route. When analysts speak of oil market risk, they're talking primarily about this choke point. Here's how tensions affect markets before a single barrel is disrupted. Geopolitical risk premium. Traders add a premium to prices based on fear, not reality. Even the threat of Iran retaliating, blocking shipping lanes, or widening the conflict can add several dollars per barrel to oil prices. Supply uncertainty. Markets hate uncertainty. When a major producer is threatened, traders price in worst-case scenarios immediately: supply shortages, regional escalation, or disruptions to export routes. Safe haven demand. In times of conflict, investors shift toward commodities like oil and gold as safe havens. That further pushes prices up and spreads volatility into financial markets. This combination of fear, uncertainty, and strategic positioning means oil markets react, often before the real economic impact hits. It's a psychological first, physical second dynamic. And because oil underpins nearly every major industry, manufacturing, transportation, agriculture, higher oil prices ripple through the entire global economy. Consumers feel it in fuel prices. Businesses see higher operating costs. Inflation pressures central banks. This is how geopolitics becomes economic reality, even without a full-blown war. Now let's talk about where fear becomes physical reality, the actual supply threats. At the center of this is the Strait of Hormuz, the narrow maritime passageway that connects the Persian Gulf to the open ocean. Why does this matter? Because about 20% of the world's oil, nearly 18 to 19 million barrels per day, flows through it. If that flow is interrupted, everything changes. But what could interrupt it? 1. Direct military escalation. If conflict between the US and Iran intensifies, there is a realistic risk that shipping lanes could be targeted, either intentionally or accidentally. Iran has previously threatened to block the strait in retaliation against military strikes. Even temporary closures or sustained naval disruption would remove a significant chunk of global oil supply from the market. The result? Prices could spike from tens to hundreds of dollars per barrel. Analysts suggest that in a prolonged conflict scenario where supply routes are disrupted, Brent crude could climb toward $100 per barrel or more. 2. Export disruptions. Beyond the strait itself, armed conflict in oil-producing regions threatens export terminals, pipelines, and refinery infrastructure. Even short-term closure of key facilities, like Iran's export terminals or nearby Gulf infrastructure, would tighten supply and send prices climbing sharply. The ripple effect stretches beyond Iran just because the Middle East's oil network is deeply interconnected. 3. Secondary market panic. Here's the twist. You don't need actual supply loss from markets to react. The anticipation of disruption is often enough. When traders fear potential blockade, producers preemptively withhold shipments or hedge their positions, each action tightening physical supply even before conflict hits. That's how prices can climb faster than physical barrels disappear. This is why oil markets today don't just respond to data, they respond to risk perception. And in a US-Iran confrontation, that risk perception is massive. Oil isn't just a fuel, it's the lifeblood of modern economies. So when global oil prices rise, especially suddenly, the impacts echo far beyond the energy sector. Here's how. 1. Consumer costs rise. Crude oil is a key input for gasoline, diesel, and transportation fuels. When crude prices go up, gasoline prices follow. American drivers, European commuters, Asian exporters all feel the same effect at the pump. As one expert noted, even a moderate oil price increase of $5 to $10 per barrel could push gasoline prices up significantly in markets like the United States. Higher fuel costs act like a tax on everyday consumers, squeezing household budgets and reducing disposable income. 2. Inflation pressures increase. Energy prices are a major component of consumer inflation indexes. When energy costs rise, they push up prices across the entire economy, from transportation to food, which depends on fuel for production and delivery. Central banks then face a dilemma: raise interest rates to cool inflation or risk slowing growth. This is exactly the kind of scenario economists warn about when oil prices spike during geopolitical crises. 3. Business costs surge. High oil prices increase operating costs for industries such as shipping, manufacturing, and transportation. Airlines, logistics companies, and heavy industry face steeper fuel bills, which often leads to higher prices for consumers and weaker profit margins. This ripple effect can slow economic growth globally. 4. Financial market volatility. Oil price spikes also create volatility in financial markets. Equity indexes may fall as investors fear slowing economic growth, while energy stocks may surge due to higher profits. Safe haven assets like gold and government bonds often rally in times of geopolitical stress. 5. Policy and geopolitical responses. Governments may tap strategic oil reserves to stabilize markets, negotiate diplomatic agreements, or alter foreign policy strategies to secure energy supplies. Long-term, rising oil prices can accelerate energy transition investments, but the near-term pain is often severe. In sum, a conflict between the United States and Iran doesn't just push oil prices up, it sends shockwaves through inflation, consumer sentiment, corporate profits, and global macroeconomic policy. The Iran-USA conflict is not just a political struggle, it is an economic earthquake. Oil markets, which have always been sensitive to geopolitics, react instantly, pricing in risk before it becomes reality. A major supply choke point like the Strait of Hormuz sits at the heart of global energy flows, which is why even rumors of disruption push prices higher. War, sanctions, retaliation, any of these amplify fear in a market built on expectations. What's clear? Higher oil prices mean higher consumer costs, higher inflation, slower economic growth, greater financial market volatility. This is how geopolitics becomes economics. And while no one wants war, oil markets have already begun pricing in its possibility. So the next time you see headlines about tensions between Washington and Tehran, remember, it's not just war coverage, it's a global energy story with real consequences for every economy on Earth.